Seeing growth is usually the top priority for investors, but for many, investing in ways that line up with their values is also key. Tim Nash is founder of Good Investing Financial Planners. Tim, and this has been your focus. Thanks for being with us.
Thanks so much for having me, Amanda.
And so I guess I wanted to start with when people think about this, does their feelings about it change based on how well they're doing? Is this a nice to add on, or is it core to a lot of people's planning?
You know, it's really interesting. So many people come to the conversation assuming that there's going to be sort of a financial trade-off, that you somehow have to sacrifice returns to invest according to your values, but you really don't have to. So people who have dug into it a little bit more really recognize that this is sort of a core part of their investment approach and is really about building confidence. We all want to believe in what we own. And so it really helps people sort of stay the course over the long term.
And that's a really important point. You're not limited to a tiny little corner of the universe here. You can access all kinds of parts of the stock market. How broad can we get? If somebody's investing their money with you, are they not investing in coal companies, or are there some coal companies that are better than others?
Well, everyone's got a different set of values. So it's important to understand that there are a wide spectrum of options available. Everyone's got their own definition of responsible. So if you want some coal companies, fine. If you don't want them at all, that's okay too. That there are a wide range of options. Certainly as we go a little bit further down the spectrum, a little bit more on the crunchy granola side of sustainable investing, that's where we can start to see some trade-offs in terms of diversification. But really, diversification is a core value. Really, what we're trying to do is own the entire global stock market, earn the same rates of return as you would otherwise, but just get sort of the nastiest things out of your portfolio and maybe use your voice as a shareholder to be able to nudge companies in the right direction.
It's been interesting because we have seen a kind of a shift in emphasis on even sustainability, certainly on things like DEI. This is more political, I think, than values-based. Have investors changed their thinking about it, or is this just the kind of the winds of politics that are blowing through these things? Kind of an interesting period during 2020 and 2021 where everyone was asking me about ESG, was the big acronym there, environmental, social governance, kind of took things by storm. And we saw lots of new products and lots of interest. And I saw so many people try to sort of enter the field and get into this space. What I would say now is that the ESG tourists are gone. The people who are just doing it to sort of catch a trend or maybe doing it for other reasons, they're gone now that the pendulum has swung back. There has been a big backlash against it, but it's really left people who really care about these issues, who are passionate, who understand it a little bit more. A lot of us in the industry kind of saw a lot of people come and then leave, and that's okay. I think that greenwashing was a really big concern for a lot of people. So in my mind, it's almost better that, a lot of the funds that were greenwashing have closed and that we have seen some consolidation. So although there might be fewer options available than there were 6 months or a year ago, I think we've got better options now than there were then. And of course, people like you who've been doing it a long time have a methodology that you can show a track record. How important is that to people that are new to this space, that they want to see the history of that you've been measuring this for a while?
Yeah, I've been doing this for almost 2 decades now of following this. And again, there is this misconception out there that you have to sacrifice returns, and it's just wrong. It's not there. When I showed the charts of the broad-based socially responsible funds, we see the returns are almost identical. The lines on the chart are just so parallel. You can earn almost identical returns, but it does give people, I think, some confidence knowing that there is a track record. Nobody wants to do something new or scary with their money. We love the tried and tested approaches. So now that we've got track records of a decade plus, and I can really show definitively that you don't need to sacrifice financial returns, no doubt that does help to build confidence.
Tim, so good to have you. Appreciate your time today.
Always happy to be here.
Tim Nash is the founder of Good Investing Financial Planners. Time for the takeaway, and you're on your own, kid. In time gone by, Canadian workers could count on a corporate pension to see them through their golden years. And while pension membership is still reasonably stable, it is still the domain of a minority of Canadians. There were just shy of 7 million of us in an active pension by the end of 2023. Those pensions are quite evenly split between the private and public sectors at 3.2 million and 3.7 million each.
What that all adds up to is that 2/3 of working Canadians don't have any kind of workplace pension. While they may receive benefits from the Canada Pension Plan, assuming they paid into it, or old age security, neither is designed to be the primary source of income for an elderly person. So what about all of those Canadians who are marching toward retirement without sufficient funds? Some of them have saved on their own, but data show that at retirement age, the average balance is $129,000, not nearly enough to generate income to support someone for another 20 or 30 years if they're lucky enough to live that long. The obvious answer to this problem is to save more, and the even more obvious and about as useful piece of advice is to start young. The math is pretty compelling that if you start saving for retirement at 18, you can get away with saving a much smaller portion of your income over time because it has a chance to grow. That's not the most useful advice for a 40 or 50-year-old contemplating a grim future. Prioritizing that future self is really the best answer in that case in order to maximize any potential savings. There are a few good strategies for doing that, and probably the best is to save before you do anything else. Deduct your savings at source where possible, so you never count the money as yours to use today. And if that feels hard, remember you are sharing with yourself. If your current self wants a restaurant meal, buy one for your future you too, and commit to putting that amount of money away. My takeaway? A lot of us hate to think about our post-work savings need because it seems like an uphill battle. But hoping the future will sort itself out, but doing nothing to help it along is not a very good strategy. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.